Why hasn't there been a recession yet? That is the name of an actual report out by our chief investment office. But really the question is, why hasn't there been one? And maybe the follow-up to that is there going to be a recession in the near or distant future? So our chief investment office has broken it all down for us, and we're going to talk about that right now in the next few minutes right here on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. Jason Draho is back here in the studio with me to have this conversation. I'm going to ask him the question that I just said in the intro. Jason, good to see you. And the question, of course, is why haven't we seen a recession? But before we actually have you answer that, you and the Chief Investment Office published a report back on June 29th. So we're talking about a little over 2 weeks ago, where you actually cited that question. I know that a lot of other publications have come out since then from other outlets have asked the same question, but you kind of were first to the market. So what's going on, Jason? We talk about the recession, that R word, for over a year and a half now, and we're all like, where is it?
It is if we get one, the most widely anticipated recession for the longest period of time.
Right.
Bloomberg does a survey of professional economists. 65% say one's going to happen in next year. It's been at least 50% since last summer. So at some point, the clock is ticking on these. So we kind of asked, well, if everyone's been expecting it, why hasn't one occurred? And so we kind of sat down and said, what are the reasons why? And we kind of identified 10 different factors of why that would be the case. Now, of those 10 factors, you can kind of distill it down to 3 kind of core ones. The first one is ultimately, despite the Fed hiking rates 500 basis points, monetary policy has only really become moderately restrictive quite recently. So it just hasn't been tight enough. The second factor is, if you look at the households kind of balance sheets of, the average person, it's in pretty good shape. It's unusual to come out of a recession, like the pandemic recession, where households are in better shape. Usually, you have excesses, you have to purge them and slowly recover. People came out in really good shape, collectively in aggregate, and that's provided a lot of kind of cushion to keep spending. And the third thing that's often kind of underappreciated is that the US economy today is a lot different than it was back in the 1970s. We're less kind of dependent on manufacturing. It's a much more services, knowledge-based economy. Economic activity today, it just tends to be less cyclical by its nature, given what we do, and therefore the economy tends to be less cyclical, less volatile, and therefore less recession prone. Something has to happen to get a recession, and we just haven't had that yet. Yeah,
I mean, certainly you're right. You said there's differences between the recessions from 40, 50 years ago till today. Is part of that also, look, we went through the pandemic. It was an anomaly, well, certainly one that we hadn't seen for a century. So there wasn't a lot of data to back up what happens when you come out of a pandemic where people are trapped in their homes for a year or a year and a half, 2 years. Is it revenge spending, revenge travel, as some people have coined it, that maybe has helped push this along?
There's 2 things that we also cited in the piece, that there's definitely distortions caused by the pandemic, extreme dislocations the first year, people stuck at home, so they're buying goods, massive increase in goods consumption. You couldn't go out, so services on travel, leisure, restaurants, those tanked.
That's right.
And they've reversed. This is highly unusual, the magnitudes of which these things move is highly unusual. So now things are getting back to normal. So when you look at the data, all this goods consumption is falling, that's that's a bad sign for the economy. It's no, it's actually just getting back to the long-term trend where we would have been had there been no recession. On top of that, you have survey data that just isn't, people aren't responding to surveys as they did before. So the data quality in a lot of cases, well, is it as reliable? Is it noisy? Can you be as confident? So you add these things, it just sort of further muddies the waters of what's actually going on and trying to figure out what's actually happening in the economy.
Right, and continually strong labor market, as we keep talking about. We keep seeing more job openings, people are working, unemployment rate remains low. It's incredible to see this where we expected it to go a different direction, and it's not. So I guess maybe the next question that I would pose to you then, Jason, is given why we know perhaps why we haven't seen the recession yet, when will we potentially see it? Now, of course, rewind the clock a year ago, I probably asked you the same question, but here we are again. Do you still see one on the horizon here?
So in the report, we basically said, things could get to recession. You would have to see the consumer start to break down. You'd have to see policy, monetary policy specifically, get even more restrictive and stay restrictive for a long time. So it's kind of slowly squeezing the air out of the balloon. At some point, it's going to perhaps pop.
Right.
But that, how long that takes, that's still an open question. It was 2 weeks ago that we published the report. If we look at the economic data we've gotten since then, growth data, inflation data, it's actually kind of further reinforced kind of the soft landing possibilities. Growth data is coming good. The labor market data continues to show strong labor market that's not really getting too much weaker. And then the most recent June inflation data, came down, big decline, and some of the key parts that investors were really focused on, like the stickier parts, that actually took a step down as well. So it's kind of further reinforcing the view that inflation is getting better, economy's holding up. If the Fed doesn't do too much more, then maybe you actually get this soft landing. So even in the 2 weeks, the odds of this happening, of the soft landing, have actually gone up, I'd say, at least on the margin.
Yeah, and that maybe that even begs the question then how people are responding to all of this. From where I sit, you could think of it two ways. Obviously, inflation coming down is a good thing for consumers, right? We can afford the things maybe we couldn't afford a year ago. Eggs were, a dozen eggs was $9, $10 a dozen in the store, and now it's come down a little bit. Mayonnaise is another product, because it's made of eggs. Everything just got more expensive. Prices are coming down. But at the same time, here we are, like, kind of trying to get around the landmines of the recession. We haven't hit one yet, and people are sort of afraid, like, one day I'm going to hit the big one, and boom, we're just going to fall off of a cliff. So there's that positivity and the negativity all in the same breath. How do you think people are feeling? What's the sentiment around this?
So it's interesting because if you look at sentiment surveys over the past 2 years, they've gotten much worse. But there's a strong correlation between sentiment measures and inflation. Because people are worried about growth, but what they really hate is the fact that the dozen eggs cost $9.
That's right.
So the further inflation went up, the worse the sentiment got. Now that inflation is coming down, some of the sentiment measures for households, for consumers, are actually getting a little bit better. And that was just based off a month ago. And now that we see the inflation data get even better, that sort of view could improve. If it improves, then people could feel a little more confident about kind of what's going on. Same thing on the recession front. Like businesses who were preparing at the start of this year, there could be a recession, we have to batten down the hatches, we might have to do layoffs. They might have done layoffs, and now they're realizing, wait a second, there may not be a recession. We don't want to lay off any more workers because things could pick up soon.
That's right.
So it actually could, slow down layoffs. And we actually saw that in the most recent weekly jobless claims. They fell, and they're still at very, very low levels. So companies are like, well, maybe let's just hold on tight. We may need these workers going forward. If that happens with inflation coming down, well, that's kind of the Goldilocks scenario. So the sentiment could shift because people realize, oh, maybe it could be a better outlook. What we don't know, though, is there is, a lot of that the Fed has done. We don't know the consequences. We can't really predict if there's going to be another banking problem. The evidence would say, history would say there's going to be issues. So there's you have to be kind of cautious and not certainly declaring victory by any stretch. But it's also I think you're seeing sort of the sentiment, in fact, kind of corporates and even personal behavior, like, oh, maybe the things are a little bit better than I anticipated 6 months ago.
Right, and obviously we know that the Fed is paying very close attention to every single tick of the tape and everything that's going on with all the numbers that are coming out when it comes to the data. And, at some point they might get more restrictive than they are today. But again, we just can't see that down the road. Obviously, if we had that magical crystal ball, we could make a prediction right here. But just really quickly, before we wrap up, Jason, from an investor perspective, what's the story you're telling them today?
So I kind of coined the term, or use the term like a fork in the road.
Yeah.
So things have gotten a lot better, but the markets of equity markets, the S&P 500 up 16, 17% year to date. It reflects a lot of this good news. So there is a question like, are things going to keep getting better, or is it already kind of priced everything, all the good news? And to keep going up, you need a lot more good news. I think that's a risk that all it takes is a little bit of disappointment on some of the economic data that's really been fantastic, relatively speaking, for about 2 months. Mm-hmm. That could disappoint the markets. The equity market, U.S. equity markets aren't cheap. So it's going to take a lot for it to kind of grind higher. So I think if you think about between now and year end, we still think with interest rates where they are, high quality bonds, still relatively attractive. Within equity markets, look for laggards. It's been one of our messages.
That's right.
If things going higher, they're going higher because these laggards are going to kind of catch up. So even if you're somewhat cautious on equities, those actually present relatively kind of good opportunities. So it's a way to kind of balance sort of the optimism and the pessimism, because they're already kind of pricing in some of the pessimism. Mm-hmm. If things are okay, they should do quite well.
Even though tech really has led the gains we've seen in the S&P 500 and the NASDAQ specifically, some of the biggest tech names, the surging seven, as we called them, but there are still some pockets of opportunity and the laggards, as you said.
I think there are 7 stocks out of the 500 of the S&P. It means there's a lot of stocks that haven't caught up, that have the potential, whose valuations are much more reasonable. And some of them tend to be more economically sensitive.
Right.
So if it looks like we actually get a soft landing, it's not quite a coiled spring, but that's kind of an analogy. Like if things are okay, then suddenly these are the things that should do really well. So on a relative basis, those look more attractive than tech, which is, again, they've done so well. They're not cheap by any stretch. If we land okay, It's the rest of the stuff that should be able to kind of catch up.
Great, Jason, thank you very much. Obviously, we have you on here frequently, but on this particular topic, we should get you back in the fall, see what happens at that Fed meeting in September, see where we are with inflation numbers and jobs numbers and getting through the summer. So we'll definitely have to revisit this again and see where we are with the big R word, recession. But thank you for having this discussion with us today.
My pleasure.
Good to see you, Jason. And for more information, you can visit our Insights website at ubs.com/views. And you can also follow UBS on social media, particularly our new Instagram channel at UBS Trending. Lots of UBS Studios content that you cannot find anywhere else. And as always, if you have questions about your portfolio, speak with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. See you soon.